Hey, Dan, I've been getting questions about 1099 programs, bank statement loans. Tell me a little bit about that.
Absolutely. We love the bank statement program. We love the 1099 borrower. Some of the cool things that we do, if you have a 700 credit score borrower, we'll go to 90 LTV up to $1 million. If you have a 720 credit score, we'll go to 90 LTV to 1.5 million. That's 1 to 4 units. Even if it's a 3 to 4 unit, we'll go to 90 LTV on owner occupied. We don't have MI on any of our products. People, when they say bank statement loans, they might not understand it. So I like to explain what a bank statement loan is. If you send in a borrower's 12-month or 24-month bank statements to us, we take a look at them and we come back to you within 24 hours. Usually it's much quicker. And we tell you what the borrower's monthly income is. While a lot of companies have a straight 50% expense factor, and I'll explain what an expense factor is in a minute, but one of the companies have a 50% expense factor. We don't. We have a sliding scale. So say you have a borrower that works from home, is a consultant, one person of us. They don't have office space. They don't have the expensive company vehicle or anything like that. We have a low expense factor of 20%. So if the borrower is depositing $10,000 a month, they have a 20% expense factor. We give them credit for $8,000 a month in income. That extra 30% is usually quite handy. If that borrower has an office that has 4 employees, well, then we might have a different expense factor of say 50%. So if that borrower is depositing $10,000 a month, we do a 50% expense factor. That's $5,000 a month we'll give to the borrower, and that's the income that we use. Some of the other cool things about these loans is, say you have one borrower that's a bank statement borrower, the wife has her own company, but the husband is a W-2 employee. So we can actually marry those. So where the wife who has the company will do bank statement loan, and the husband who's a W-2 employee will add both of those incomes together and we'll have it one loan. So we can actually marry those two borrowers. Kind of cool. That's on bank statements. On 1099, it's very simple. It's a straight 10% expense. So if you have a 1099 borrower as a 1099 from last year and the year to date stuff, we'll use a 10% expense factor. So same amount, say $10,000 a month they're receiving, and they have a 10% expense factor, we'll credit them for $9,000 a month in income. That's how we determine, then you can determine the debt to income ratio from there. But it's a really cool program.
What about you had mentioned multifamily? I factor in rental income on here as well?
Yes, you can. So when you have that, and so say we follow Fannie Mae guidelines, we determine the 25% vacancy factor. Don't have a 4 unit, borrower's going to live in 1 unit and rent out the other 3. We'll use a 25% vacancy factor, just like Fannie Mae does, and we'll use 75% of the rental income on those other 3 units to add into the borrower's income.
Dan, on these bank statement loans, who are they good for? Who do you see using this?
On the bank statement and 1099 loans, we're seeing them on primary residences, on investment properties and second homes as well. So if you have a 720 score, we'll go to an 80 LTV on investment properties. And that LTV does not change whether it's a single family or a multifamily. Condos on pubs as well. Just a great program.
You deal with a lot of loan officers, brokers, all kinds of people. Where are you seeing people get wins, successes, and where are they getting their business from?
Oh, great question. So this is what I'm seeing on the marketplace today is I'm seeing loan officers that are everybody is going the real estate agents and trying to get business that way. And there's so many agents now that are just getting more calls from loan officers than they are getting from people who want to sell their house. So, I always joke around when everybody zigs, you want to zag. So let's go a different direction. Let's talk to CPAs and accountants and say, hey, when you have your self-employed borrower, we're coming up near the end of the year. So when the accountant says to his client or her client and says, hey, if you take this deduction, you won't be able to qualify for a mortgage. But we don't look at tax returns when we're looking at the bank statement program or the 1099 program. So loan officers should be reaching out to CPAs, accountants, enrolled agents, talk to them about all the taxes they're doing. The other great source for these loans is BNIs. So they can join their local BNI and be the local expert or as a loan officer. But if you look at every member of a BNI sitting in that group, every single one of them is self-employed. So all of a sudden, the self-employed borrower is actually the person you're sitting next to in your group. And the funny thing about BNI people is all their friends are self-employed. So when and then they tell their friends and then they tell their friends. And all of a sudden, you're the go to person for bank statement loans. You're the go to person for 1099 loans. And, I always joke and I say, the riches are in the niches. If you get a niche of self employed borrowers, you'll see your pipeline grow.
Oh, 100%. You've got to grow your brand locally in and around those people with the products that you have. That is great advice. And any other tidbits that you have from this is a long version of Mahoney's Minute. Any other tips here this week?
Yeah, today's Bogus Minute is being brought to you by John Jerkovich.
Awesome. Well, if anybody has questions, Dan Mahoney's over at American Heritage. I'll put a link in here as to how you can get him. This is not a guy that was playing college football last month and truly a mortgage expert. Go ahead and reach out to Dan should you have any questions about non-QM. Thanks,
Thank
Dan.
you, Mr. I appreciate it.